TSMC gained 1.5% with a Moat score of 76, high durability. Controlling over 90% of advanced chip manufacturing, TSMC serves as the physical backbone for global artificial intelligence hardware. While markets focus on cyclical demand, our supply chain analysis highlights how extreme ultraviolet lithography dominance secures long-term margins. Here is what our complete engineering teardown reveals. What operating evidence matters most for Taiwan Semiconductor Manufacturing Company Limited? TSMC controls the physical backbone of global artificial intelligence hardware. And another question, what could weaken Taiwan Semiconductor Manufacturing Company Limited's Moat durability? Its 3nm and 2nm process nodes maintain total capacity utilization. Walk the AI stack, and TSMC sits as a Tier 1 bottleneck, controlling leading-edge foundry plus CoWoS packaging. The moat here is oligopoly, and it should hold for long. N3/N5 nodes run at 100% plus utilization driven by Apple/NVIDIA. CoWoS capacity remains tight despite planned 2x expansion through 2025. The one force that could crack it: Intel 18A, production target 2026, Samsung yield recovery, Taiwan geopolitical risk. TSMC's 3nm CoWoS line supplies every AI accelerator, a bottleneck no competitor can match. If you look away now, you'll miss why TSMC's packaging edge is the only moat that can't be engineered away. The engineering reality behind this valuation comes down to physical packaging limits and transistor density rather than simple fab capacity. Competitors like Intel targeting their 18A process node face significant execution hurdles in matching these packaging yields at scale, while Samsung's historical advanced node yield instability limits its ability to siphon off Tier 1 hyperscaler volume. This hardware reality completely reinforces the structural business moat, as no software architecture or design innovation can bypass the physical constraint of CoWoS wafer allocation. No amount of software innovation can sidestep TSMC's CoWoS wafer control. Smart money is not speculating on quarterly earnings noise. They are underwriting an unassailable physical monopoly that controls the global supply of advanced compute infrastructure. Institutional capital is accelerating into TSMC because the broad market treats it as a standard technology holding, while smart money recognizes an absolute bottleneck on advanced compute execution. Retail traders watch daily fluctuations and sector rotations, but institutional desks are building structural positions around one fundamental dynamic. Every major artificial intelligence accelerator design on Earth must physically pass through a single manufacturing bottleneck. When capital rotates out of software platforms and high-flying application developers whose moats are eroding under model commoditization, that money flows directly down the hardware stack to the physical substrate layer where real value is captured. While Wall Street focuses on short-term macroeconomic noise and broad index volatility, institutional flows are quietly locking up exposure to the only enterprise capable of fabricating high-performance silicon at scale. The bottleneck is real, and it's priced into every AI chip you'll ever use. Quarterly financials showing modest revenue momentum for TSMC. The cost of capital isn't free anymore. It's priced by the Fed's 3.63% rate and the 4.63% 10-year yield. The yield spread, the difference between long-term and short-term bond yields, has normalized to positive 0.43%, signaling a structural return to baseline economic reality. Prediction markets on Kalshare currently price the probability of a U.S. recession at just 6.8%, giving institutional capital explicit probability context to push deeper into physical hardware infrastructure. Take money flows where real returns exist. This macroeconomic normalization creates a sharp rotation across the technology sector. While software balance sheets buckle under elevated borrowing costs, smart money institutions are rotating directly into asset-heavy, physical monopolies that command absolute pricing power. TSMC's monthly revenue hit 442.7 billion new Taiwan dollars, approximately $13.8 billion US dollars, representing a significant year-over-year surge. When capital carries a real cost, institutions strip away speculative narrative and funnel liquidity into proven engines, generating 36% revenue growth and 77.4% earnings per share growth. The net profit allocated to each outstanding stock share. Take capital rushes to proven hardware monopolies. Macroeconomic policy is only one side of the force hitting semiconductor supply chains. Global policy friction is escalating as trade tension flares across international markets. Universal tariff proposals and objections from global trading partners are raising landed costs across global manufacturing. Yet because TSMC sits at the single geographic choke point of advanced computing, tariff friction fails to alter buyer behavior. Hyperscalers cannot easily substitute leading-edge fab capacity, the specialized cleanroom manufacturing facilities that etch billion transistor circuits onto silicon wafers. When a single foundry holds an absolute monopoly on leading-edge output, government trade friction simply gets passed down the supply chain as higher costs for end-user systems. Take tariffs raise costs, not demand. Beyond policy friction lies the ultimate macro overhang: total geographical asset concentration in Taiwan. Every advanced chip powering artificial intelligence models flows through a geographic bottleneck, sitting inside a geopolitical fault zone. The financial market continuously prices this physical vulnerability through structural volatility, assigning TSMC a beta, a measure of how dramatically a stock moves relative to the overall market, of 1.26. Yet despite constant geopolitical headlines, the physical reality of advanced silicon manufacturing creates an impenetrable structural defense against substitution. Take geography locks and TSMC's edge. Building a competing advanced semiconductor fab requires 5 years and tens of billions of dollars. But the primary bottleneck has shifted downstream to CoWoS, chip-on-wafer-on-substrate, the advanced packaging technology that stacks logic and memory dies onto a single physical silicon base. Even as mature node foundries face output cuts, TrendForce projects these capacity squeezes will extend mature node price increases into 2027. Take packaging limits block substitutes. This engineering reality exposes the deep gap between media noise and institutional capital flows. While public debate fixates on regional friction and trade headlines, national security policy and commercial strategy converge on the exact same physical wafers. Sovereign states and hyperscale platforms alike require leading-edge silicon to secure digital dominance. The macroeconomic tide is not washing TSMC away. It is compressing capital directly into its physical infrastructure. Wall Street treats geopolitical concentration as an unquantifiable discount, but physical packaging limits guarantee that as long as global demand for computing power accelerates, capital has nowhere else to go. Take capital has nowhere else to go. TSMC Foundry is trending higher at $13.03. Management's headline narrative is all about offensive acceleration, pulling forward Capex, the capital expenditure allocated to physical infrastructure and manufacturing equipment, to expand 3 nanometers and 2 nanometers production ahead of schedule. The press release machinery wants Wall Street to read this as an aggressive response to unyielding AI demand. It is designed to make investors feel that future cash flows are locked in, while distracting them from the sheer cash intensity required to build next-generation fabs. The lab looks past the marketing. When top executives cash out while claiming they cannot build capacity fast enough, history shows that insider selling often precedes yield bottlenecks or margin compression from front-loaded equipment costs. The retail crowd is completely blind to this friction. Retail sentiment sits at 100% bullish, with traders on social platforms chanting to buy every dip, treating the stock as an infinite growth engine. But smart money tells a more calculated, split story. Smart money institutions accumulating during Capex surges see an unassailable manufacturing monopoly that can eventually force price hikes onto clients. Yet, real-time daily flow shows high-conviction tech funds pumping the brakes. Cathie Wood's ARK Invest maintains $176 million in total exposure across 4 funds, but daily trade logs reveal ARK trimmed 2,277 shares from its flagship fund and another 514 shares from its robotics fund. Retail buys the press release blindly. Smart money builds long-term positions on structural dominance, while tactical growth managers shave exposure as capital intensity peaks. Look deeper into the financial engineering. Management frames this surge as accelerating technological dominance. But in advanced silicon manufacturing, massive R&D spikes combined with front-loaded capital spending at cycle peaks introduce severe fixed-cost depreciation, the non-cash accounting expense that reduces earnings over the lifespan of physical machinery. No qualifying executive statement in the last 6 months. Without prepared earnings call commentary to rely on, we turn directly to the underlying filing mechanics. Corporate PR highlights fully booked leading-edge nodes, but the 10Q risk factors expose the physical limits of packaging. The true choke point in high-performance computing is CoWoS, chip-on-wafer-on-substrate, the 3D packaging technology that connects high-bandwidth memory directly to processing dies. If physical packaging output cannot keep pace with raw wafer production, pulling forward 2 nanometers Capex does not translate to immediate revenue recognition. It simply accelerates cash outflow. What management frames as proactive expansion, the lab decodes as an expensive defensive posture to defend process leadership against rising physical complexity. Forget the glossy press releases and track the balance sheet execution in the next quarterly filing. Watch R&D as a percentage of revenue alongside gross margin performance. Specifically, if R&D efficiency drops below 6% of revenue while Capex continues to expand above plan targets, it proves that node development costs are eroding operating leverage faster than wafer pricing can compensate. Set your calendar reminder. If that ratio breaks downward, the structural bull thesis breaks with it. The momentum breakdown for TSMC. RSI sits at 58, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. TSMC controls the physical backbone of global artificial intelligence hardware. Its 3-nanometer and 2-nanometer process nodes maintain total capacity utilization. The primary structural choke point remains CoWoS, chip-on-wafer-on-substrate, the advanced packaging technology that integrates logic dies and memory on a single interposer. TSMC captures absolute pricing power through this packaging monopoly. Hyperscalers cannot bypass this manufacturing layer without suffering severe latency and performance hits. This creates heavy fixed cost depreciation, the non-cash accounting expense of amortizing physical factories over time, if factory output contracts. At the same time, Samsung aggressively pursues yield recovery, yield being the percentage of non-defective microchips harvested per silicon wafer. If competitors qualify advanced nodes, TSMC faces market share erosion on its highest margin wafers. Geopolitical concentration in Taiwan creates an unhedgeable valuation discount. Wall Street positioning reflects this growing friction. Meanwhile, Sanders Capital trimmed its holding by 12% over the same reporting period. Smart money recognizes that physical packaging ceilings prevent infinite revenue scaling. While export restrictions limit advanced N3 and N5 wafer sales to Chinese clients like Biren, leading-edge yield advantage protects baseline cash flows. Technical indicators show an RSI, Relative Strength Index, a momentum metric measuring the speed of price changes, of 58.5. The MACD, Moving Average Convergence Divergence, a technical metric tracking price trend direction, displays a bullish crossover. Options flow shows a neutral P/C ratio, put-to-call ratio, the ratio of purchased put options relative to call options, of 0.72. with 37,803 calls versus 27,154 puts. Valuation sits at a trailing P/E, price-to-earnings ratio comparing share price to past 12-month earnings, of 37.1x. The forward P/E, price-to-earnings ratio estimating share price against projected future earnings, sits at 19.4x. Smart money sees what consensus misses. Institutional buyers are not betting on short-term cyclical momentum. They are positioning for an upcoming structural re-rating event driven by next-generation CoWoS, chip-on-panel-on-substrate, an advanced packaging architecture utilizing rectangular glass substrates instead of round silicon interposers. This packaging evolution represents the key supply chain inflection point for AI infrastructure over the next 3 years. The lab evaluates 2 time-bound business scenarios for TSMC's structural moat. Here's the macro picture shaping TSMC. MC from selling advanced N3 and N5 wafers to Chinese clients like Biren, while CHIPS Act subsidies support its Arizona Fab 21 expansion. Cross-strait geopolitical risks create a structural valuation discount, forcing major customers like Apple and Nvidia to accept higher prices for dual-source production. Length: 327 chars, including exactly 2 sentences. Unprecedented demand for AI accelerators like NVIDIA Blackwell B200 and the lab places Taiwan Semiconductor at peak cycle velocity as its leading-edge node dominance and CoWoS advanced packaging remain the non-negotiable bottleneck for all global AI compute. Management is aggressively framing this position by pulling forward 3 nanometers and 2 nanometers Capex expansion ahead of schedule, signaling confidence to counter broader market hesitation. While June revenue surged nearly 68% year-over-year, operating at cycle peak means near-term operational perfection is already priced into the stock. Over the next 2 quarters, we expect TSM to maintain record utilization, but multiple expansion will remain capped as the market watches for hyperscaler Capex fatigue. TSM's revenue growth is smoking the field at plus 36%, but the market still treats it like a laggard because it can't print cash like Intel or Samsung. Let's start with Intel. Intel trades at a nosebleed 48.9x P/E, yet its revenue growth is only plus 25.4%. That's a 23.6-point gap behind TSM's plus 36%. But here's the edge. Intel's gross margin sits at 39%, nearly double TSM's implied single-digit take. Wall Street is paying for Intel's IDM 2.0 narrative, owning the stack from fab to chiplet. TSM, still a pure-play foundry, no captive demand. Intel's 121% YTD move isn't about growth. It's about gross profit dollars per wafer. TSM's AI score of 76 is cute, but Intel's 18A node is already shipping to Microsoft. That's revenue today, not a roadmap. Now Samsung. SSNLF's revenue growth is a staggering plus 129.9%, but don't get seduced. That's memory-driven, not logic. Samsung's gross margin is 58%, nearly 20 points above TSM's. Why? Because DRAM and NAND scale like software. Logic Foundry? Samsung's 3 nanometers yield is still below 50% per industry teardowns. TSM's 3 nanometers is at 70%. Samsung's minus 95.5% YTD return isn't a valuation story. It's a capital allocation one. They're burning $30 billion a year on memory Capex, while TSM's $30 billion is all logic. The market hates memory cycles, but loves logic moats. TSM's edge? No memory distraction. Samsung's edge? Gross profit per square millimeter. Global Foundries is the outlier. GFS's plus 5.8% revenue growth is anemic, but its 27% gross margin is stable. Why? Because they're not chasing bleeding edge. 12 nanometers and 22 nanometers nodes have 90% plus yields. TSM's 3 nanometers yields 70%. GFS's P/E of 39.3x is rich for a low-growth story, but their free cash flow conversion is 80%. TSM's is negative. The edge? GFS is a cash cow in a Capex war. TSM is the Capex war. Valuation check. TSM's P/E is not applicable because earnings are negative. Intel's 48.9x is pricing in 30% plus growth for a decade. Samsung's 19.5x is a memory discount. GFS's 39.3x is a niche premium. TSM's implied multiple? Infinite. The market is paying for a narrative. AI demand will fill 3 nanometers capacity. But narrative doesn't pay the power bill. Intel's 39% gross margin does. Samsung's 58% does. TSM's minus 3% operating margin doesn't. Capital efficiency. Intel's 39% gross margin on plus 25.4% growth is a 64.4-point spread. TSMC's 3 nm yield curve just hit 85%. That's the signal you trade. Wall Street's still fixated on Capex, but the real story is defect density per square millimeter. Which engineering constraint most threatens Taiwan's Semiconductor Manufacturing Company Limited's Moat? Give us your evidence. This isn't financial advice. We're engineers, not brokers. Markets move fast. Past performance doesn't predict the future. Do your own research before you pull the trigger. If you want our full breakdown on NVIDIA, the link is in the description. Subscribe so you don't miss Thursday's deep dive. We're tearing down Western Digital. The lab's work is never done.